This is an excellent outcome, certainly for any recent shareholder or long-term shareholder of the medicines company.
Absolutely.
You know, you've had very good returns at Sarissa, taking these positions, reconstituting boards, and sort of taking your time, but getting a very positive outcome. What is it particularly about biotech that lends itself at least to your approach?
Okay, and thank you. You know, in biotech, there's a couple factors that we think sort of make it particularly good for the type of investing we do. One of the factors is that there's very high margins and very high barriers to entry in this business. So when a company has a successful product, it has a government-issued monopoly on that product, which is appropriate because it's a lot of work to get there. But they have this sort of high-margin business that has barriers to entry that are unlike most other businesses in the economy. I often use like restaurants as an example. If you and I were to get into the restaurant business and we start a restaurant, you know, down the street from here, somebody could very quickly copy our idea and open across the street, and unless we had the best service every single day, we would lose share. Whereas when a company has a drug, while it's on patent, to the extent doctors and patients recognize the value it provides to society, they continue to use it even if the company sort of misallocates cash flows going forward. So it's sort of easier for companies in the biotech space to kind of get away with mismanagement in the near term.
To get away with mismanagement.
Get away with bad capital allocation.
Right. So they are doing that for a while because they have this high-class problem, so to speak, of having this barrier to entry.
Exactly.
Which leads to what, though? And what do you look for in specific? You look for, I guess, companies that are sort of not doing all they could do because they do have this kind of recurring cash flow from a potential drug.
So we look for companies where basically what we do is we DCF a company as if it's run optimally for its shareholders. And we compare that to the market cap. And we sort of say, okay, well, we know, let's look at a company and how many drugs they have and what markets they address, and we can figure out what the margins are, how many salespeople you need to optimize that value, that kind of thing, and do a very simple DCF, and then compare that to the market cap. And when we do that analysis, we don't take account of the fact that, oh, the company has some skyscraper headquarters in New York City and 12 corporate jets and all this sort of thing. All we really do is say, what's the best way to optimize the value? When there's a huge difference, we look at it. And we say, okay, are there ways that we can put leverage on the company? So we'll often hear from big institutional shareholders, large mutual funds call us all the time, you know, expressing frustration with capital allocation or operations at some of the companies. So that's a good window into us knowing, okay, the shareholders are generally kind of unhappy with the place.
But give me a sense here, Alex, specific to the medicines company. It's a perfect example, right? You sold for almost $10 billion. You're the chairman of the company. You helped reconstitute the board. The stock was single digits at one point, wasn't it?
Yes, and just a year ago, I guess it was 17, yeah.
Okay, so what happened there? What did you do effectively there as an activist investor that helped to bring this out? So
Medicines Company is a good company, good people, where they had a large collection of assets that had been put together over time. Most of those assets were not actually creating economic value. They were, in fact, in the short term, destroying it. They had businesses where the costs of being in the business were higher than the revenues. So we were able to sort of separate out those businesses, sell them off, and focus in on what the value that we felt was the highest value piece there, which is this drug candidate, which is really a very, very exciting program, and bring in a team that was just laser focused on executing on that. We put in options policies for employees so that everybody was incented to sort of beat the goals, move the drug forward as quickly as possible, which is good for society, good for shareholders, good for everybody. And good to all to then work out well.
So how many years do you usually expect that you're going to be involved with a company, whether on its board or certainly being active in the stock when you get involved?
So it's very hard to predict, but we assume that we'll be dealing with a multi-year investment. Sometimes, after 6 months, we can have a situation where a large pharma comes in and they say, okay, we want to buy it, and if we agree on a good price, that's fantastic. But we sort of we plan that it's going to be a few years. It usually takes a few years to sort of implement change, get if board turnover is necessary, implement that, management turnover, that type of thing.
Right. Let me come back to a name you know very well. You were on the board and have been for a long time. In fact, going back to your days at Icon, Biogen.
Yes.
We got very important news a month or so ago from the company when it went back and took a look at its treatment for Alzheimer's and the studies that it had done and said, hey, you know what? They were statistically relevant.
Right.
What are your expectations there? The stock had a huge pop on that day, but we really haven't heard much since then. Should the market have been as excited as it seemed to be about the prospects for this drug?
I think that look, that drug is now will be submitted to the FDA, and they're the experts to determine, kind of whether the drug should be approved and what the kind of what the market would be and the risk benefit of that, and they're the experts. But from there was from the data that's been presented publicly, there's a real reason to believe that this is a very important therapy for potentially a very important therapy for Alzheimer's patients. Unfortunately, as you know, it's a horrible disease, basically untreatable. There are a few drugs in the market that kind of have small effects in terms of.
One would imagine that an effective treatment in some way that even just retarded the growth or the progression of the disease would conceivably become one of the largest selling drugs in the world very quickly.
That is certainly possible, yeah. So and we have that kind of at Sarissa, certainly we have that view that's possible. It's, I don't want to get in front of the FDA, and they have to review these data and carefully analyze them. But if you sort of look at the market potential and you look at the effects that we've seen so far, admittedly in a trial that had some flaws, but the effects we've seen so far could be huge.
And finally, for your firm itself, you're a little over $1 billion. Again, we're sort of highlighting you've had a very good track record based on some of these long-term situations. Do you think about going after some bigger prey at this point, or are you going to sort of stick with the market caps that make sense given your relative size right now?
So we look at all size companies. To first order, it's more important like when we have leverage over the company. So if we've heard from 3 or 4 large institutional shareholders in a company that's maybe there's 10% holders in a 50 or 60 billion dollar company, we arguably have more leverage there, even if we have a smaller position in terms of the percentage of shares outstanding than a smaller company where we don't know the shareholders or that type of thing.
Right.
So we're looking at all market cap ranges, and the answer is probably some bigger ones, yes.